Hello and welcome to Macro and Market Update for September 2023. In this month's edition, we focus on the US FOMC meeting, impending US government shutdown, activity data out of China, the announcement of India-Middle East-Europe Economic Corridor, India's inclusion in the JP Morgan Emerging Market Bond Index, the much discussed drop in India's household financial savings, crude price rise, El Nino, upcoming RBI policy, and finally conclude with our view on economy and market. Then, let's begin. US Federal Reserve kept Fed funds rate unchanged, but it did leave the door open for one last rate hike later this year. Fed cited three explanations for the current economic strength: the solidity of household and business balance sheets, the neutral rate at which policy is neither expansionary nor restrictive has risen, and that the lags between policy action and real economy reaction mean that full effects of the Fed tightening have yet to show up in the shape of slower activity. Markets have pushed out rate cuts possibility in the US to beyond July 2024. So, US rates and in turn global rates are likely to remain higher for longer. And this in turn begs a question on the current valuation in global and Indian equities. The US Congress faces a September 30 deadline to pass bills to fund the government spending. But lawmakers are still stuck in political disagreements over the size of the spending. Failing to pass funding bills before the deadline will require the US government to partially shut down. At the time of the recording, the outcome is pending. If shutdown happens, the impact on the economy and financial markets should probably be negligible. Since 1976, there have been 22 such funding gaps. Even the longest shutdown in US history, which occurred in 2018-19 under the Trump administration for 35 days, was estimated to have reduced US GDP by 0.1 to 0.2%. Government shutdown, unlike hitting the debt ceiling, does not jeopardize payment on US government bonds. Investors can thus be relatively relaxed about this political drama. Markets are focused on downside risks in China. The People's Bank of China has been defending the renminbi around the current fixing of 7.2 to the dollar. Given this stance, for it to capitulate to market pressure would probably take another big negative shock. That doesn't look like the way things are headed in the near term. The economic data are turning more positive at the margin as the government ramps up the policy support and exports are stabilizing. Longer term, there's no question that the mounting troubles of property developers and overstretched local governments create risks of more shocks to the system. While the government is reluctant to do public bailouts, behind the scene it is extending implicit and explicit support to borrowers to allow them to restructure the debts. Conclusion: RMB has policy support at the current levels and could remain so in the near term. India inked India-Middle East-Europe Economic Corridor (IMEC) on the sidelines of G20 meeting. US endorses this corridor. These are resource-consuming projects and would require cooperation between countries. A lot can go wrong in between. However, if it is executed successfully, it helps provide an alternative to the currently used route of Suez Canal, which is prone to disruptions. It is also claimed to substantially reduce cost and time taken to transport the goods from India to Europe. This is also touted as a small alternative local route to China's Mammoth Belt and Road Initiative. Another data point which gathered attention last month was drop in net financial savings by the Indian households. it has dropped to 50-year low of 5.1% of GDP by the end of FY23, led by a sharp jump in the loans taken by Indian households. Personal loan taken for atypical reasons, that is, reasons other than house, vehicle, education and credit card, has grown significantly. Even though there are minimal signs of stress yet, such trends do need more attention. Increasingly, this had not put any pressure on the cost of funds as yet, owing to low corporate credit offtake, sharp liquidity infusion by RBI post-COVID, which has normalized only in FY24, and a healthy foreign capital inflow. Cost of funds or rates could still stay supported for the next 1 or 2 years, given the creation of new source of foreign funds. Here I am referring to bond index inclusion. However, beyond that, fundamentally, such a low household savings is a concern from India's macro stability point of view. From equity market perspective, it tells us that households are borrowing to sustain their spending habits. Unless income catch up, consumption-oriented stocks may still have some challenges to grapple with, though consumption is such a diversified basket that there are always pockets of opportunity. Brent jumped above $90 per barrel. Higher oil prices are negative for India, but this time the government's intervention on fuel price control should limit the direct and second round inflation effects. On the fiscal, the costs will be borne by the oil marketing companies in the short term and by the government eventually via higher subsidy. This means a limited inflationary impact but a bigger spillover on the twin deficits. From companies' perspective, we think that the best of input cost falls and hence gross margin gains are behind us. Australian weather has declared El Nino, but Indian Weather Bureau sees limited impact owing to local weather conditions over the Indian Ocean. If it is to be true, it bodes less of a concern for Indian agriculture and food inflation. Overall, projections indicate 5 to 6% CPI inflation in the coming months. We expect an extended pause in policy rates for now. RBI has announced a phased extinction of the incremental CRR by first week of October to prepare for increased currency demand by the public between October to April. After 2 years of speculation and discussion, JP Morgan finally includes India in its emerging market bond index and assigns 10% weight to it. Inclusion will start from June 2024 in a staggered fashion until March 2025 and could potentially get around $25 billion of inflow from now until FY25. This is a positive move sentimentally and helps to cap how high Indian bond yields can rise and rupee can depreciate in the current backdrop of higher global yields and higher crude prices. It creates an additional source to fund fiscal and current account deficit. In future, it becomes another yardstick for policy makers to keep Indian macro house in order. However, beyond the initial settlement years, it will also be an additional source of volatility to external account, rupee and bond yields, requiring RBI's intervention. Bond markets had largely priced in this possibility weeks ago and hence were largely unmoved despite this positive sentiment. Overall, in India from macro perspective, higher crude, reduced domestic savings, centers increasing tilt towards social spending and external growth headwinds are emerging macro concerns. But there are positives on continued domestic growth momentum, supply side inflation management, continued positivity on service exports an additional source of foreign capital. Over the last month, Indian bonds were range-bound. Elevated global bond yields and no distinct visibility of monetary easing cycle in the immediate future could cause yields to stay sideways in India. Nifty crossed the monumental 20,000 mark mid-September, but retraced some of these gains. Marginal up moves could be seen across the market cap. Expensive valuation is the biggest factor driving our cautiousness on Indian equities. Valuations mean reward, though they can stay out of trend for long and variable lags. Then it becomes important to choose sectors or segment which provide relative margin of safety. At present, large caps and commodities provide a still fair valuation. Otherwise, bottom-up stock picking stays in the focus. Secondly, the macro guides for a single-digit or low double-digit return over the near term in Indian equities, whereas risk-free rates are 7% plus, which means it would be prudent to diversify into bonds and gold. Signing off for this month. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.